Ismail, Director of Management Programs at the School of Business. Thank you for joining our discussion on the economic implications of COVID-19, which is one of our Business Reconfigured series of webinars. You can see the full list of the upcoming webinars of the School of Business Executive Education website, and you will find the link in the chat. Before we begin, a couple of tips to maintain a smooth streamlining connection. We are keeping the voice muted from our end, and please turn your cameras off. If you have any questions, please write it in the chat box, and we will do our best to address them all at the end of the presentation. The webinar is scheduled to be concluded at 3. Now I would like to introduce our speaker, Dr. Ahmed Safty, who is an Associate Professor of Practice at the AUC School of Business. Dr. Ahmed has over 20 years of experience working for think tanks, policy-making institutions, and regional organizations. He also provides consultation in the area of economic policy management for policymakers in 12 MENA countries. He also taught on both academic and executive levels. Dr. Safty has a PhD degree in International Economics and Finance from Radis University. Dr. Ahmed, thank you for joining us today and for leading the discussion.
Okay, thank you for you, and thank you for the participants for showing up for this meeting, and I hope it will be interesting for you. Today I'm going to discuss the economic implications of COVID-19, starting from the global perspective. Then I will briefly go through the regional part about the Arab countries, and then move to the Egyptian implications, taking into account what's going on globally and regionally, because both of them are extremely important for the Egyptian economy. For my presentation, I will depend from the data point of view on what came out on the IMF World Economic Outlook that came out April 2nd, where the IMF put a baseline scenario, including all sort of forecasts for the global economy on a regional basis and on the main countries and the main economies here. So just to give a background about what's going on and what the IMF is expecting to happen for the baseline scenario, the key points here is that the IMF is predicting that the global economy will experience the worst recession since the Great Depression, something that we didn't see before, even after 2008, after the financial crisis of 2008. This is going to be stronger because it's financial, and at the same time, from the supply side, from the real economy, it had very strong implications. The effect of the lockdown because of the COVID-19 will be having a strong, it will have a strong impact on the global growth dramatically. It will actually, the global economy is expected to shrink by 3% for 2020, and according to different scenarios, would pick up, but under all the scenarios, it will not pick up as fast as possible from the level point of view to reach the situation before COVID-19. So the IMF is predicting recovery partially for 2021, but at the same time, knowing that we're still in a situation that has lots of uncertainty. Things are not going to be easily set from the projections, and we have major problems predicting what's going to happen in the future and major risks according to this. Okay, so other things, the IMF highlighted also that we have two different impacts according to the readiness of the economists. So the IMF is expecting that the advanced economies are going to be will be easy in their effort to weather the crisis, while emerging markets and developing economies will not be able to do the same on their own. And they predict that in the future, they will need the assistance of advanced economies and multinational institutions, financial institutions like the IMF and the World Bank. So that's the main conclusion of the WEO, April 2020. And if we go back to see what happened for like early during this year that led us to the situation that we are in right now. Actually, it wasn't only one crisis, it was double crisis at the time, twin crisis at that time. We had a problem with the lockdown after the spread of COVID-19 and announcing that it's going to be a pandemic. But at the same time, we had an oil price war resulting from the breakdown of OPEC Plus agreement, where Russia renegated from the agreement and Saudi Arabia retaliated, and we had flood of the oil supply in the economy. We all with lots of problems on the demand side, and both those effects led to major disturbances in the financial markets worldwide. So if you look at the financial markets, first of all, before even the lockdown, there were signs that some economists saw as sort of an indication that the US economy specifically is going to have a sort of recession soon. It started late last year when we have an inversion of the yield curve in government in the US. And then we had, after the crisis, the whole yield curve for the US dropping under 1%, which is a major indication that the economy is slowing down and it will take a long period of time to recover. So after the crisis, the yield curves dropped, the spread, credit spread, which covers the risks, increased for the US and for the emerging markets. At the same time, equity markets just like collapsed, and we had a major disaster because of this. Initial round of financial turmoil in the global economy. Governments and central banks around the world started to respond to the shock, and they responded in a very strong way. Central banks around the world cut interest rates. Programs started to appear for central banks to exceptionally buying non-traditional types of financial assets from different parties, including even extending credit for Main Street, not only for financial institutions. Fiscal stimulus started to appear through tax relief, spending on infrastructure, including the healthcare system, and social spending, including cash transfers for unemployment and so on. So the policy responses from the fiscal and monetary policy were really strong around the world, easing, like having more of quantitative easing by the central banks, and at the same time, fiscal stimulus by the governments, which were needed during this period of time in order to limit the negative impact on the economies, on the real economy. According to the IMF, for the baseline scenario, actually, the predictions for the baseline scenario, and here I'm stressing that this is the baseline scenario because this is the scenario that is moderate in some sense. They are expecting that the global economy will contract by around like 30%, by 3% in 2020. The advanced economies and the oil-producing countries, especially in the MENA regions, are the ones who are going to be affected the most. Emerging market also is going to be affected negatively, but it's not going to be balanced somehow, because if you look at the main economies or the major economies in worldwide, you will find that Europe, US, Japan, UK, all will have very strong negative impact, while countries like China and India are going to have slowdown of the growth, but not to enter into the negative growth rates or shrinking of the economy. Again, the thing that I was stressing is that this is a baseline scenario. The baseline scenario is assuming that things will be unwound in 2020. So we will have, during the second half of 2020, we will just like ease the situation, and then gradually unwound. The situation is going to be unwound, and things will be returning back to normal in a very speedy way in this sense. However, the IMF mentioned 3 major scenarios that could make the situation even worse. The first scenario is that longer outbreak in 2020, which, as you can see on the left-hand side, would lead to a major dip and longer period of time for recovery for the GDP, oil prices, both in advanced economies and emerging markets. The second scenario is that you will have a new outbreak in 2020. So we now having a break in 2020. Then things will maybe recede a little bit, but in 2021 we will have a second round of COVID-19 pandemic, and this, of course, is going to increase the chances of having much deeper slowdown of the economy and much longer period for recovery. And the last scenario is a longer outbreak in 2020 plus a new outbreak in 2021. So we have both continuation of the outbreak, the impact of the outbreak in 2020, but we will be hit again with a new outbreak in 2021. And this is actually a major, this is the stress test, I would say, for the baseline scenario. This is the worst case scenario. And the results of those of the last scenario is going to be extremely severe for the world economy. Okay, so now how things should be returning back to normal. Everybody is talking about the different shapes of recovery. There are different scenarios for recovery. Now we have the dip after the COVID-19, but how the economy is going to return back to normal, this is the depending on the shape of the recovery. The worst case scenario is that you have an L-shaped recovery, meaning that you will have a very long period of contraction for the economies of the and for the GDP, and we will not be able to recover as fast as like within the next few years. The one that we are hoping for is to have a V-shaped recovery, meaning that the economy is dipping very fast, but once we open the economy will rebound very fast too, and the situation is going to be as sort of a temporary shock that will return back, and things will return back very fast to normal after that. The more realistic scenario is a U-shaped scenario. U-shaped scenario meaning that you have slowdown, then you have the hit, we go down, we remain down for a significant period of time, not very long as the L-shape, but we start to recover after a period of time. The worst case scenario, if we consider that the L-shaped is not probable in this case, is the W-shaped scenario. The W-shaped scenario means that the economy is going down, then it will respond fast, but because we have fatigue of the situation with the coronavirus, we will prematurely open the economies, open the social contacts, and so it's a very bad scenario, because if we think about the policy options of the policy makers around the world, it seems that, and I'm borrowing this from Dr. Mohammed Al-Arian, that till now the policymakers, especially in the major economies, were considered this from the game theory point of view as one round situation. So they are responding with everything right now to this situation. But if it's a multi-round, meaning that things are going to happen again, maybe in the future, again, if we have another outbreak in 2020, for example, or if we are prematurely opening the economy, then we have a setback, then the policymakers would need to have another round of strong interference or intervention in the market, which would come at a point where they don't have enough tools, or the governments are incurring lots of debts, and the situation is going to be very bad. So we are, again, the L-shaped recovery is not, I wouldn't put high probability of getting it. V-shaped is the optimistic, U-shaped is the more realistic. The W-shaped is something that we should worry about, especially with policymakers, after they put everything right now to face what's going on. Okay, so maybe they won't have the space to react strongly after that. And actually, in this scenario, people start talking about the MMT, the modern monetary theory, but this is something not for this lecture, and I don't think this is an option that's going to be available for anyone. So what would be the net impact globally for this? It seems from the dynamics of things that are going on right now for businesses, definitely they will have more debt, will have more bankruptcy cases. Some of the businesses would have less adaptability by some for the new environment, for the new, to adopt new business models, and accordingly they will have a varying degrees of difficulties. For governments, there are two major issues here. The governments are interfering or trying to support the private sector in a very intensive way right now. And this creates sort of entanglement with the private sector activities. So you have a sort of mixing between the government and the private sector activities, which would need to be clarified in the future. This is the first thing. The second thing is that definitely governments responding to this crisis would have higher levels of public debt in the future. For central banks, again, they are doing something that unheard of for central banks to do traditionally. They are having much larger size balance sheets right now. Maybe they will have lots of significant amount of bad assets, especially when they are going after the high yield securities, buying high yield securities, and at the same time involving in providing liquidity even for Main Street, meaning that directly for the public in some countries. For the society, and this is again, I'm borrowing this from Dr. Ilarian, we have worrying signs about more inequality everywhere. There were a huge redistribution of wealth because of what's going on in the financial markets and the way that the government interfered, selecting which institutions and to be supported and which are not going to be supported. So you will have lots of wealth redistribution that could affect could increase the inequality. Also from the income side, because for the income, some were able to adapt through online working environment, while others do not have this sort of advantage, and accordingly you will have a wider gap in incomes, and unfortunately also for generations, because it seems that most of the problems from the unemployment and the unemployment claims, again, like if we think about the US as an example here, were mainly from the youth. So again, problem with the inequality, redistribution of wealth, income is going to have a sort of also will have a major impact on inequality in income, because some people will be able, and some jobs are able to adapt to the new environment, where others will not be able, and then the last generation. Now, I'm going to go quickly through the Arab economies because of their impact on Egypt, then I will talk about the Egyptian case. So for the Arab economies, actually, for the IMF was predicting that for the major, from the growth perspective, the vast majority of oil exporting countries, mineral exporting countries, and the less diversified, less reformed countries are going to suffer tremendously around 2020 before having a sort of a recovery in 2022. The one exception, which is very interesting here, was Egypt, because Egypt was the only Arab country that the IMF is expected at a slowdown of the economic growth, but we still achieve real economic growth in 2020 and 2021 around like 2%. Why the reason behind this? Mainly, I think, because of the reform program that we implemented in 2016. It made the economy more resilient to such shocks. But again, this is the baseline scenario, because it seems that there are some really negative impact and some weaknesses for the Egyptian economy, especially from the external sector, and I'm going to talk about them in a couple of minutes. So Egypt was the exception for the shrinking of the economy in 2020. The expectations is that you would have a slowdown from 5.6% growth rate, real growth rate in 2019 to 2% only in 2020, and then we will go up a little bit slightly to 2.8 in 2021. For the budget balance as a percentage of the GDP, which reflect to a certain degree the internal imbalances, most of the Arab countries who are dependent on oil will have a major impact, negative impact of this shock. So we can see that from the graph, the majority, the vast majority of the oil exporting countries would have a very negative impact on the budget, because of course the revenues coming from the oil sector is going to be minimal compared to the ones before the crisis, because of the oil and the result of the developments in the oil market. Again, for an exception here, which again would highlight the impact of the reform program that Egypt adopted in 2016. Egypt is not expected to have much higher deficit because we're not dependent on the oil export or the oil revenues as a major source of income for the government. So the budget deficit, the overall budget deficit is expected, according to the IMF, to drop from to increase from 7.4% in 2019 to 7.7% in 2020, before getting lower in 2021 at 6.6%. So again, Egypt could be considered as a sort of an exception here. But at the same time, I will talk I'll talk a little bit about the possibility of some negative impact on the fiscal side, again, when I start talking about Egypt. As for the current account, again, for the majority of the oil exporting countries, they will have major negative impact during 2020 because of the problem with the oil. But for Egypt, again, it sounds like we are going to, at least from the current account balance, we are going to have a slight increase in the deficit, not very much, around like 4.3% compared to 3.6% in 2019, which means that, again, because of the reform program, we will have a sort of stable and moderate deficit during the period from 2020 to 2021. Okay, so those are the three major indicators: the real growth rates, the government budget balance, and the current account balance of the balance of payments, and how things are expected to develop for the Arab countries, and how Egypt, compared to the rest of the Arab countries, would the performance of the Egyptian economy, how it would look compared to the rest of the Arab countries for the next coming years. Okay. Now let's move toward Egypt and discuss the Egyptian economy a little bit about the impact here and what are the major vulnerabilities for the Egyptian economy. Okay. Before the crisis, our expectations for the fiscal year 2021, these were the expectations according to the government of Egypt and the IMF. Both were having almost the same figures. We were expecting a real growth rate to be around 6%, unemployment rate about 7.5%, inflation rate within a single digit of 7.4%. We have a primary budget balance of 2%. The overall budget deficit supposedly would be reduced, public debt would be reduced, external sector indicators would be improving, including an increase in our international reserves. However, after the crisis, we had sort of predictions from both the IMF and the Egyptian government. First of all, for the growth rate, initially, the Egyptian government, from the Ministry of Planning point of view, they predicted that the growth rate is going to slow down from 6% to 4.5%. While the IMF predicted that we are going going to have 2% in 2020 and 2.8% in 2021. Then, within the last couple of days, the Ministry of Planning adjusted their predictions for the growth rate, and now they are saying that there is a high chance that we are not going to achieve more than 2% growth rate for 2021, compared to 6%, that the one that we used to predict before that. Okay, out of the other sectors, for the budget sector and for the external sector, we can see that for the budget sector, the prediction is that we still have a moderate deficit compared to the other Arab countries, and from the trade sector, still we can have moderate current account balance deficit. And the main thing that happened during the last quarter, which can give us an indicator of the external vulnerabilities, is that if you look at the position of the international reserves for Egypt, actually it dropped by around $5 billion over the first quarter of 2020, and it's related to a major foreign exchange source that we depended on since the starting of the reform program of 2016. So now, to talk about the vulnerabilities facing the Egyptian economy, we can have negative impacts on tourism, travel, and hospitality. Of course, the financial sector, the stock market, the government bonds market suffered from the crisis. Retail, of course, is suffering from the crisis. Oil and gas sector, of course, suffering from the crisis. But for some positive impact, according to the Ministry of Planning, we have pharmaceuticals, food industry, agriculture, and telecommunications all flourished under the crisis. Okay, but now let's look at the external sector to see the major sources of weaknesses for the Egyptian economy, the things that we should worry about. Okay, here on the upper left-hand side, you have the major components of foreign exchange resources from the current account point of view. So for the current account of the balance of payments, you will see that the major source of foreign exchange for the Egyptian economy is workers' remittances. Okay, it's the gray bars on the upper left-hand side, as I mentioned, followed by tourism, which is the brown bars, and then to a smaller extent, the Suez Canal. But mainly, it's, again, if you rank them, workers' remittances, this is the major one from the current sources. Then tourism, almost half or even less than half sometimes of workers' remittances, and then Suez Canal, which is again maybe like 1/3 of the receipts from tourism. On the capital and financial account side, you will see the major problem in the way that Egypt is financing its current account deficit. Because if you look at the development of the three major tools that you can see from the financial and capital account of the balance of payments, you'll discover that the major element to finance the current account deficit and at the same time helped Egypt a lot accumulating its own reserves is the portfolio investment. Portfolio investment here, it covers to a large degree some of what we call hot money, foreign investors investing in government securities here in Egypt. So assuming that you have a sort of stable exchange rate, you have higher yields on Egyptian government bonds than the cost of borrowing abroad, you create a chance for foreign investors to borrow from abroad, bring their foreign exchange to Egypt, sell it, and invest in government securities, which would lead to inflow of the foreign exchange. The major problem here is that this is something that we depended on after 2016, but the history says that it's really would appear during the good times, but whenever we have bad times, it's the first thing that would lead to a major negative impact on the Egyptian economy, which happened, if you remember, after 2011, it was one of the major source of drainage of our foreign exchange. And then in 2008, after the Turkish and Argentinian crisis, the same thing happened, where we have huge outflows and with the last crisis, actually it created lots of pressure on our foreign exchange. Actually, the foreign exchange for Egypt dropped, as you can see from the lower left-hand side graph, from $45.4 billion by the end of 2019 to 40.1 by the end of March 2020. The 5.3 billion drop here, according to the central bank, reflecting in the largest part the outflow of the portfolio investment from Egypt. So again, under such crisis, they will leave you, and at the same time, you will have it's not going to drop to zero, it will going to turn to be negative. So it's exaggerating or aggravating the situation for the Egyptian economy. So this is one of the major problems here. Again, why it's one of the major problems? We, after the situation, after the reform program, we started the reform program of 2016, we depended on this side of this element of the financial account inflows, waiting to getting the results of the reform program, and we can replace it in the future with the foreign direct investment. Unfortunately, because of the international environment, because of what was going on during from 2016 till now, the foreign direct investment in Egypt never picked up, especially for greenfield investment that comes to Egypt for the first time. So outside of the energy sector, the investment did not really pick up for the Egyptian economy. The foreign direct investment never picked up in a way to replace or to take over the responsibility of closing the financing gap and accumulating the reserves from the portfolio investment. So we depended a lot on the portfolio investment, and we're still depending a lot on the portfolio investment. So why I'm mentioning all those things? Because if you look at the situation right now, today, from the external foreign exchange resources, you will find almost all of them we have major problems with them. Let's take them one by one. Workers' remittances, the most stable, the most positive, the positive, most significant one that even continued after 2011 for the Egyptian economy. It's the one that helped the economy tremendously from the external point of view. But now, as you can hear and you can see from the news, we have major problems with the workers' remittances. We have a developing situation in the GCC countries. They have a major impact of the COVID-19 plus the drop in oil prices. We can see that, we can expect that there will be layoffs for lots of expatriates. We can see that from the last couple of days, the developing situation in Kuwait, and this is expected to be even stronger in the future. So workers' remittances, again, is going to be impacted by this in a way that we didn't even see after 2011 with all the political and economic disruptions that happened in Egypt. So this is the first thing. Tourism, again, you can see what's going on with tourism. Tourism actually is the one that is going to be the first to be affected by such lockdown and the last one to recover after the lockdown. Why? Because of many reasons. Because of the worries about the impact of the virus, because you never know when we will resume travel, international travel. One of the major sectors that can give you an indication of this, one of the major sectors globally that been negatively impacted is the airline sector. Airlines, all of them, they are facing tremendous negative impact of this, and maybe lots of them are not going to survive. And again, for the reason of the worries about the COVID-19, because also of the income and the debt impact for the individuals affected by COVID-19, you cannot predict that the tourism is going to pick up very soon, or even after things would be normal, it will take time to pick up again. one thing that happened during also the last couple of days that the Egyptian government decided to partially reopen the sector for domestic tourism, but of course, we're talking here about foreign exchange. So even if it helped partially the sector because they are under great stress, but again, for the Egyptian economy as a whole, the negative impact on tourism is going to be really bad and long-lasting. For Suez Canal, again, if you follow the news, and happened before, whenever we have very low oil prices, the Suez Canal would have very fierce competition from other routes. Lots of, like if you go to the news today, you will discover that Maersk and some other shipping companies, they just started to decide, okay, we are going to go around the Good Hope route instead of going through the Suez Canal. Even that we, for some routes, we cut the fees for Suez Canal by 75%. Why? Because it's cheaper to go around with very cheap oil than just passing through the Suez Canal. So again, Suez Canal is expected as a source of revenues to drop. If you look at the financial and capital account, definitely portfolio investment is not going to recover soon, and maybe will continue to have its own negative impact. FDI is not expected to pick up, especially when you know where the FDI for you is coming from, and all those countries will really affected hard by the impact of either the COVID-19 or the oil price collapse, and accordingly you will have a major problem here. The net impact of this, again, is going to be significant. It's going to put pressure on your reserves. It can put pressure on your exchange rate. It will widen the financing gap, the external financing gap. And if you see, and this would lead, I think, to a certain degree to getting back into increasing external borrowing by the Egyptian government if they were able to get this in with moderate cost. Something that I will mention later on. This is one of the reasons why we are returning back to borrow from the IMF, including borrowing under a program, under a standby arrangement. Okay, so again, I was just highlighting here the major impact on the external sector in Egypt, both from the current account point of view and from the capital and financial account point of view. And you can see that because Egypt depending on few major sources of foreign exchange, all of them are very sensitive to external shocks. This would magnify the impact on the external sector in Egypt here, and accordingly we'll have a major financing gap. Pressure on the foreign exchange started to appear during the first quarter, and maybe we'll need to go and borrow again externally in order to close this financing gap significantly. Okay. So again, this is just a summary of what I mentioned, what was remittances, what sort of impact there. It used to bring around $26.8 billion. This is in 2019. For tourism, it's second most important, 13. And again, you can have major problems, including you can have, of course, the central bank did a sort of initiative to help the tourism sector. But if the situation continued, if the situation didn't pick up soon, maybe you would have sort of a problem of non-performing loans from this sector going through the banking sector. Suez Canal revenues, I mentioned the idea of the problem of having other maritime routes more competitive, and accordingly some of the shipping companies can avoid going through Suez Canal by taking longer routes because of the cheap oil right now in the market. Foreign portfolio investment, again, this is the major source of stress of our foreign exchange position here in Egypt, and definitely it's going to cause lots of problems for the Egyptian economy in the future. Foreign direct investment, lesser impact. It never picked up. But again, if you remember where most of the foreign direct investment came to Egypt after 2016, it was mainly on the energy sector, and the energy sector now is not expected to be really attractive, which means that we can see even much slower foreign direct investment coming to the countries, coming to Egypt during the next coming years. So, how the government is responding to this from the fiscal sector, which we can have. We can see some of the response by the government. The pre-budget statement that came out around, I think, Sham al-Nassim, the week of Sham al-Nassim, the Ministry of Finance announced that they are expecting the budget deficit to narrow to 6.3% from 7.2%. But again, they stressed that this is before taking into account the full impact of the COVID-19 on the Egyptian economy. Revenues were expected to rise, spending is expected to rise to reach by 8.8%. Primary budget surplus projected to remain at 2%, which is good for the Egyptian economy in order to achieve sustainability of the public debt. And they were expecting it to rise a little bit to 82.8% of the GDP, after it was around like 7.78% before that. But again, this is not. And those were some of the figures that been mentioned as not including the full impact of COVID-19. The Minister of Finance mentioned that they would need to see clearer how the situation is developing, how they will develop the policy, and then to show the total impact of COVID-19 on the budget later on, but not on the pre-budget statement. So that was some of the major activities that, or major policy tools that have been mentioned for the fiscal side. Increasing spending on healthcare, of course, on education, scientific research, social welfare, commodity subsidies, wage bill, all of those things being taken into account in the budget to have sort of softening the impact on, to improve the healthcare sector and the education sector, and at the same time to soften the impact of the crisis on the most vulnerable groups. Also, Egypt decided, or the government of Egypt decided, to have a stimulus package of 100 billion Egyptian pounds to face this, the impact of COVID-19, including increase in the pensions, increasing in the cash transfer system, of the systems of the Careful and Karama. 50 million Egyptian pounds were designated to support the irregular workers by 500 Egyptian pounds each for whoever would show up as a regular worker can benefit from the 500 Egyptian pounds. Increase of the allocations for medical supplies, medical staff, and medical professionals. Energy costs were lowered for the entire industry sector. Real estate tax relief provided for the industrial and tourism sectors. Again, for the tourism, this is important. Subsidy payout for exporters, and $50 billion for the billion Egyptian pounds, sorry, for in support of the tourism sector. They had some tax reliefs for agriculture, for capital gains and dividends in the market. That was from the fiscal side. From the monetary side, the central bank, again, as most of the market-based banks, central banks, did sort of easing of the monetary policy. They cut, the central bank cut the policy rates by 300 basis points. Announced an initiative for preferential interest rates on loans to SMEs, industry, tourism, and affordable housing. They increased the limits on for electronic payment systems, mobile phones, bank cards, internet banking. They initiated a new debt relief initiative for individuals at risk of default. Microfinance also, it's not related to the central bank, but the FRA announced an initiative to cut, delay the payments, 50% of the payments of the installments till the end of the maturity of the loans on a case-by-case basis. the central bank launched, as many other central banks did, stock purchase program in order to inject liquidity and prevent sort of drying of the liquidity in the market. So usually the central banks will increase their budget, not the budget, the balance sheet in such cases by buying assets that they are not usually buying. And this was one of the action by the Egyptian Central Bank, Central Bank of Egypt, by announcing a 20 billion Egyptian pound stock purchase program, mainly to inject liquidity and helping the market in this sense. They had some other measures for COVID-19, limits on the daily withdrawals and cash withdrawals and depositing, but they removed it for Ramadan. Now, if you think about the internal economy, we mentioned about the external side of the economy, the major impact is going to happen through workers' remittances, tourism, Suez Canal, portfolio investment, and even foreign direct investment. All of these factors are going to cause major weaknesses for the external position for the Egyptian economy. Now, from the domestic side, if we take the fiscal side, again, the announcement by the government or by the Ministry of Finance, that was the pre-budget announcement, and they mentioned that this is not taking into account the impact of COVID-19. Definitely, the budget could run a much larger deficit. The government already is taking some measures to counter this negative impact through raising, as we heard yesterday and today, some of the fees and excise taxes on certain items like pet food and so on. But you cannot avoid a major impact on the tax side, because you'll have lower income tax revenues, you will have lower VAT revenues, lower import tariffs. And again, if you think about the revenues by the government, lower Suez Canal revenues. But at the same time, if you have those sort of extra ordinary measures to cope with the COVID-19, then you will have a higher deficit than predicted on the budget or the pre-budget announcement, and maybe it would lead to a higher cost of financing for this. One thing for sure, the public debt is going to go up again. At least this is from my point of view, both external and domestic, with the current sort of stimulus that the government is doing to cope with the COVID-19 and its impact on the economy. Okay, the last thing here is that, again, if you see the internal imbalance by that COVID-19 is causing for the budget deficit, which is expected to rise beyond the levels that have been mentioned in the pre-budget announcement by the government. At the same time, if you consider the impact on the external sector, both the current account and the capital and financial accounts of the balance of payments, then you left no option but to go back to the IMF, which was already announced last week. So now, to face the situation, to face the sort of impact from the COVID-19 on the Egyptian economy, Egypt is returning back to borrow from the IMF. They are borrowing under two facilities, one very specific for this crisis, which is the rapid financing instrument. This is a sort of financing facility that the IMF offer for countries facing major external shock like the one that we are facing right now, and the IMF opened it to face the consequences of COVID-19. But more importantly, we are going for a standby arrangement. A standby arrangement means that this is a sort of a program. It's program related finance. It's shorter than the ones that we took in 2016. It will be a year, maximum a year and a half, and mostly to face temporary shock to the external position. While the other one, the one that we took in 2016, under the extended fund facility, usually it's for longer, more structural deficit in your problems with the external position, the balance of payments, and your reserves. So we are going back again for a program. But the thing that I would like to conclude here is that for the standby arrangement, I think the government is going to take advantage of affordable foreign exchange credit that could come from the IMF, while the program itself, I think it would be consistent with what the government was planning to do. So I don't think it will have sort of major changes from the ones like the ones that we saw after 2016. It will be more going in the same direction as from both the monetary, fiscal, and exchange rate policies, but you will have a good source of financing to close the temporary gap in your external financing that's been pushed by the COVID-19 situation. So I will conclude here by this, and I'll look for the questions. And thank you so much. Okay. Before I leave, those are the upcoming webinars. And again, as been mentioned before, you can check on the chat and the website for the coming events if you would like to participate. Okay, thank you so much.
Thank you, Dr. Ahmed. We have a few questions, if your time allows to take some of it.
Sure.
Sure. The first question comes from Dr. Sameh. He is asking, from your personal point of view, what will be the shape of the recovery?
I hope for a U-shaped recovery. Okay, this is the more realistic one. This is the coming one, but I worry about the W shape because it seems that it's not only us, it's everywhere. People are getting really a sort of fatigue out of the situation, and I worry that we are going to open the economies and the social contact in a premature. Okay, for me, there are 4 major things that needed to be done to be sure that things are not going to get worse again. The first thing, of course, for many countries to develop their healthcare system, to be able to get to a cheap, effective, and fast way of testing for COVID-19. The third and fourth, of course, to have a vaccination, cheap, affordable, being able to be produced, to be mass produced and distributed around the world in a quick way, and of course, to have a treatment, effective treatment. Without those 4 elements, I think it's prematurely to just open the economy, having this sort of hoping to return back to normal, worrying about the economic cost, because actually the main problem is that you can just pick up things and then you will be hit again by another round of pandemic, which would make the situation even worse. And if it turned to be worse, the governments will not be the governments and central banks will not be in a better position to deal with the negative economic impact at that time. So this is my worry. Realistically, and hopefully it will be a U-shape, but I worry much about the W-shape.
Doctor, we have another question from Mr. Hazem Ayad. There were reports that Egypt by 2030 will be the 6th highest economy worldwide. Is this still realistic?
Okay. Who knows? This is because it's not only about Egypt. It's about the rest of the countries too. How strong is going to be the impact for the rest of the countries? You have lots of countries that, again, it will depend on a number of things. It depends on the continuation of the reform process, having an economy that is resilient for such shocks, because this is not going to be the end, the last shock that we as Egypt or in the global economy will face till 2030. Maybe we'll see other types of shocks. So having a more resilient economy against the shocks, more diversified, balanced from the domestic demand and external demand, always being aware of the impact of the government budget, the fiscal and the monetary policy, and following the right track of those 2 policies will be very important to achieve some. So again, I cannot predict if this is going to be the case in 2030, because it doesn't only depend on Egypt, it depends also about on the other countries and how they are dealing with this. And it's very difficult right now to do predictions for 2030 according to this.
Doctor, I think we have time for one last question.
Sure, no problem.
Question from Dr. Mona El-Shulani. She is asking, how sustainable are the fiscal policy efforts that were executed recently to mitigate the impact of COVID-19?
Okay. Again, for the fiscal side, there are good news that we have really achieved high degree of sustainability and consolidation since 2016. So from 2016 till 2019, aside from the COVID-19 impact, the fiscal policy and the budget was really moving toward a really good position. Again, they announced a number of measures, including the 10 billion Egyptian pound package, stimulus package, including some social impact. There, I think the main thing that will happen here is that most probably you will have some countermeasures, things like the ones that we saw today, increase on the excise taxes and on some luxury goods or goods that or some other goods that have negative externalities and low degree of price elasticity to be able to capture some of the revenues. But again, I would expect larger budget deficit because of this, and at the same time, maybe sort of increase in the specifically on the domestic debt for the government because of those measures. Again, for the ones that have been taken till now, this is the initial reaction, but no one knows what's going to happen if we are facing with a longer and more severe impact, especially if, again, as I was talking about, if we have a sort of W-shaped recovery worldwide and in Egypt, where we can have another round of COVID-19 and another dip of the economy, then maybe the government would have to interfere again. So again, the major thing is here is that this, if it's one round game, that's it, we are dealing with it with 100 billion, and then everything is over, we don't need to interfere again, then the situation could be sustainable. But if we have multi-rounds where we can where the government would need to interfere again and again to face some sort of extra impact or reversal of recovery, then this could be problematic. Other than that, again, the debt, the public debt situation is still sustainable, but let's hope that it will continue this way.
Dr. Ahmed, we have around 4 or 5 questions, all talking around the area of the exchange rates.
Okay.
So the reserve decreased from 45 to 40 billion. How would this impact the exchange rate? And if the central bank is doing any efforts to support the sustainability of the exchange rates?
Okay, a couple of things. The first thing is that, again, that was the statement of the central bank about the recent developments of the foreign exchange reserves. The central bank mentioned in this statement that the 5.4 billion or 5.3 billion dollar drop in reserves during the first quarter was mainly related to the reversal of portfolio investments. And this was under the old repatriation system. The ones who participated in the repatriation system and they wanted to leave, the central bank was obliged to provide them with the foreign exchange. So I think this is the reason why we have this drop, because of the repatriation system. The central bank, under the IMF program, is not supposed to interfere on the buying side, on the selling side in the market. That means that if you have a pressure on your exchange rate, the central bank cannot just sell reserves generally in order to support your currency. You can only interfere on the buying side. That means that if you have excess supply in the market, the central bank can buy in order to increase or enhance the position for the foreign exchange in general within the central bank. The impact here definitely is going to be negative. You will have, again, there is one thing that, of course, we talked about the sources of the foreign exchange, and we can see that we have major negative impact on all the major sources of foreign exchange for the Egyptian economy, including, again, if you see on a day-to-day basis today, the two major pieces of news, I think, from this point of view. The first one is the situation with the expats in Kuwait, and the other one, we're talking about Maersk deciding to go for the alternative route through the Good Hope route for shipping instead of going through the Suez Canal. This can give you an indication of the severity of the situation. So again, it depends on how the recovery will happen, but I doubt that we will be able to return back to normal again. It seems that the Egyptian government with the IMF are agreeing those lines of credit, one the emergency one, the other one under the standby arrangement. Both of those financing will be helpful in they are mainly to support, to close the financing gap and to support the foreign exchange situation in Egypt. We have a slowdown, of course, of the imports, but I think we need to see how the situation will develop. But I expect that we will have more pressure on the foreign exchange and on the Egyptian pound exchange rate, at least within the next couple of months.
Thank you, Dr. Ahmed, for the informative session and for your insights. And thank you, everyone, for attending. And we look forward to seeing you in our upcoming webinars. We will be closing the session now.
Thank you so much for everybody. Thank you for participating with me, and I hope to see you soon. Bye.